Welcome to another Seed Startup video. You need to hear this if you're an entrepreneur looking for funding. Venture capital is a form of financing provided to small and medium-sized businesses that are believed to have high growth potential. These businesses are often in the early stages of development and operate in technology, healthcare, or other innovative industries. Venture capitalists, or VCs, are individuals or firms that invest in these businesses, providing capital in exchange for equity or ownership in the company. Imagine a group of wealthy individuals pooling their money together to invest in a promising startup. That's essentially what venture capital is all about. These investors, known as venture capitalists, are betting on the success of these young companies, hoping for significant returns on their investment. Venture capital is a high-risk, high-reward game. VCs are looking for companies that have the potential to disrupt industries and generate massive returns. They understand that not all of their investments will be successful, but they hope that the few that do succeed will more than make up for any losses. In simple terms, venture capital is like planting a seed in the hopes of growing a giant sequoia tree. Not every seed will sprout, and even fewer will reach their full potential, but the ones that do can create an entire ecosystem. The origins of venture capital can be traced back to the post-World War II era in the United States. One of the earliest examples is the American Research and Development Corporation, or ARDC, founded in 1946. ARDC's goal was to invest in companies that were developing technologies that had the potential to benefit the US economy. One of ARDC's most notable investments was in Digital Equipment Corporation, or DEC, a company that would go on to become a leading computer manufacturer. ARDC's investment in DEC is considered by many to be the first true venture capital investment. In the 1960s and 70s, the venture capital industry began to take shape. The formation of the National Venture Capital Association, or NVCA, in 1973 marked a turning point, providing a platform for VCs to connect and share best practices. The industry experienced significant growth in the 1980s, fueled by factors such as the rise of the personal computer and the deregulation of several industries. This period saw the emergence of iconic venture capital firms like Kleiner Perkins Caufield and Byers and Sequoia Capital, which would go on to back companies like Apple, Google, and Amazon. Venture capital plays a vital role in fostering innovation and entrepreneurship. It provides a critical source of funding for startups that might not otherwise have access to traditional forms of financing, such as bank loans. Venture capitalists bring more than just money to the table. They often have extensive networks of contacts, industry expertise, and operational experience, which can be invaluable to early-stage companies. Think of venture capitalists as mentors or advisors who not only provide financial support, but also guidance and connections to help startups navigate the challenging path to success. They can help connect entrepreneurs with potential customers, partners, and employees. Additionally, the involvement of a reputable venture capitalist can lend credibility to a startup, making it easier to attract further investment, talent, and customers. In many ways, venture capital acts as a catalyst for economic growth, driving innovation, creating jobs, and supporting the development of new technologies and industries. For entrepreneurs, securing venture capital funding can be both a blessing and a curse. On the one hand, it can provide the resources needed to scale their businesses and achieve their ambitions. However, it also comes with certain trade-offs, such as giving up equity and control. Advantages of venture capital include access to large amounts of capital, strategic guidance and mentorship, industry connections, and increased credibility. These advantages can be instrumental in helping startups overcome early-stage hurdles and achieve rapid growth. However, there are also potential drawbacks to consider. Entrepreneurs may have to relinquish a portion of their ownership in the company, potentially diluting their control and future profits. Additionally, the pressure to deliver rapid growth and meet investor expectations can be intense, potentially leading to burnout or compromising the company's long-term vision. Ultimately, the decision of whether or not to pursue venture capital is a complex one that depends on various factors, such as the entrepreneur's risk tolerance, the company's stage of development, and the industry in which it operates.